Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, Lance Pederson. Today I have with me Charles Carillo with Harborside Partners. How you doing today, Charles?
Doing well, Lance. How are you?
Doing good, man. Real good. So why don't you share a little bit with us about how you got into real estate? I always like to start there. It's like what attracted you to the real estate business? What's sort of that origin story? And I'm always curious too as to what sort of caused you, the reasons and rationale behind forming Harborside Partners, right? Like why do people, form companies and what's sort of behind that? And then we'll sort of jump in and nerd out on, your investment philosophy and things like that. But always curious to hear where people come from and why they got, into this line of work.
Yeah. So my dad has been investing in multifamily and commercial real estate since the 80s. So I grew up in it, and my dad never had third-party management. He self-managed everything himself. And it was, I would 100 plus apartments at different points, and never syndicated. It was all 100% owned by himself. He had one partner for a few of them, and he outsourced a lot of it. He had a team that managed it, but he never went to a third-party manager company that we usually see a lot of people work with, like we do today. And that gave a lot of glimpse into the back of what was going on. And obviously, you're in elementary, middle, and high school. I mean, your last thing you're really worried about in that age is cash flow and freedom and all this kind of stuff. I think that was something that attracted me a little later on, maybe after college, that how powerful it really was. The properties weren't really sexy properties. I mean, they, some of them were like D properties, some of them were C- properties. As my dad got a little bit more seasoned in real estate investing, became better properties, and that's what he kind of instilled on me was, hey, when you buy better properties, buy better areas. And when I was looking to buy my first property after graduating college, just a 3-family that I was going to house hack, so live in one floor, I actually rented out the second bedroom and rent out the other 2 floors. And he really pushed me to buy in a better area, and did. And I still own that today. And then I got a little over my head, I guess you would say, on the renovation portion of it. I didn't know how much work would be done. And my dad was kind of mentoring me, but from like an arm's length. And a couple of years later, got that all set. A couple of years later, bought another property, and that went much smoother. And that's actually my best asset that I own 100% myself. And then bought another property like a couple of years later. So that was kind of my thing of buying property and just making sure that you're not buying in war zones, and really buying in C+ areas and above. I would never drop below that. And there's some people that know what they're doing there. Yeah. That's not something for me. And everybody knows your sweet spot. And my sweet spot is C+ areas, the B areas. I think that's it. Workforce housing, as we call it in the industry. And right now, for the last several years, that was back in Connecticut. I moved to Florida in 2012. And down here, we've been really focusing on syndicating properties for the last few years.
Got it. So when you say is there another person you kind of went into it on? Was that, when did you form sort of Harborside?
I formed Harborside Partners in 2016, and we really started getting involved in syndications in 2018. I was kind of figuring out how we were going to structure and what we were going to do. I never really bought properties with partners, other than I bought some with my brother before, but like outside of the family partners, I've never done before. So it was figuring out what my specialty was and what could I bring to a team, and then also finding partners that complement what you're doing. So, I work with a few different partners within Harborside, and we kind of do like a non-exclusive where it's, one of my partners, if we find deals that are large enough that we need both of us to work on, we'll do that. And then what we do is we partner with other strategic partners in different parts of the country. Our really focus is the Southeast, the Midwest, and the Mid-South. Really all landlord-friendly states. I'm done after living in Connecticut and investing there and owning property still there. I'm not buying any more property up there. So it's especially with COVID, you see how difficult it is to work in some of these states. So be very careful when you're investing, whether active or passively, in the areas, in the markets, and making sure that you're investing in places that are a little bit friendlier for you to do business in.
Yeah. So in addition to, as you sort of get this off the ground, I know you have your own podcast and stuff as well. So what's the objective with that? And like, what are you trying to accomplish with your podcast? And like right now, from your strategic business standpoint, are you like in the relationship building sort of mode of like, hey, get my word out there, help educate people? What's sort of the thought process behind your podcast?
Yeah. So with my podcast, what I do is I really focus on working. About half of my downloads come from foreign investors and half come from the US. So I have a pretty loyal foreign investor following, and that's people that are expats or people that are foreign nationals or people that are just foreign that want to invest in US real estate. And that's kind of been my niche. And years back in college, I started an online payment processing business, which I merged with one my brother had, and he runs it full time now. And I was doing a lot of work at one point. We were working with a lot of international partners and clients, and I would spend 2 to 3 months a year, usually in Europe, Eastern Europe. And when you talk to people, you're talking to people about doing business or what you're in there, you're like, what else are you investing in, stuff like this. And I would tell them, US and real estate, and explain everything and how great it is. And then they're like, oh, how do I invest in it? And this is before we were doing anything with syndications or anything like that. And I was like, I don't know, like how you would do it. So that's kind of when I started my podcast. It was really, we just talk about US real estate investing. And then I have some episodes that are really focused on foreign investors. Like I said, there's even hurdles if you're an expat, right? And you're going to have trouble probably getting a mortgage if you're living out of the country one way or another, even if you have some US income still. Mm-hmm. So that's something that someone that was thinking going active might say, hey, this is passive. It might be easier for me. And then someone coming from a different country, there's, you're going to a different country anywhere outside the US and you want to invest in real estate. There's going to be some that are very similar, like if you're investing in Canada. Mm-hmm. But there's going to be some that are completely backwards of what you see as normal. And that's kind of what I want to educate my listeners on. And both US investors that never invested into commercial cash flow property, maybe just bought a house or something, or interested in buying their first property. And then foreign investors that just figuring out the lay of the land here in the US when investing.
So, I know it's a complicated sort of subject, hence why one could, dedicate an entire podcast to it. But just at a high level, right? So whether I was a Canadian citizen or whether I'm, in Ireland or whatever. What is your general advice to people when they ask like, hey, I want to participate, in these opportunities in US based real estate? Are you basically saying, well, you really need to form some kind of US taxpayer, or do you rely on, or do you first go to like, hey, evaluating the tax treaties between, the two countries? Because I know that there's that issue with Canada and most other countries have no concept of an LLC. Whereas most real estate investors in the US house all of everything's sort of an LLC, not everything, but more often than not, an LLC is involved. And then for some foreign citizen to invest as a partner, a member into an LLC is sort of, you can't take advantage of a tax treaty.
Right.
And so, without getting, once again, hey, I told you we're going to nerd out on the show, but it's, how does that conversation go? Because obviously they want the benefits. Like people, it's easy to sort of pick up, why US real estate can be a really great investment for the reasons you said, cash flow and appreciation and things like that. But where do you start with that?
So like the Canadian one, I guess, is the most famous one, I guess you would say, with US investing. And as I understand it, we set that up as LLP. And that's because when the tax treaty was signed, I want to say in the 80s, but I could be wrong on that. The LLC wasn't even a thing. Yeah. So the LLC came out afterwards. And that's why that's the reason for that. But the US has many tax treaties with many countries. The main thing is when I'm talking to someone initially, they come to our website, I set up a call with them and we're talking and, what are your real goals of what you're trying to find? And then really figuring out, is this even like for you? Some people want to put money here for a few years. That's not really the goal. You want someone that's comfortable with, hey, this is a 5, 7, 10-year investment, right? We're not flipping real estate here. And this is going to be something where our goal is to have a quarterly distribution and then also have some sort of event at the end or possibly partway through if we refinance it, where you're going to get a large chunks of your investment back. And at that point, then it's really just pointing them to different professionals that we work with. Yeah. So I work with a group of CPAs, a group of attorneys, and mainly based in Florida, but this is something that's nationwide, so it doesn't really matter where they're interested in investing in or where they're located. And then also there's a couple lenders if people are interested in that as well, like passive or lenders for foreign investors here in the United States. But it's it really just figuring out what their goal is and then connecting them with several different providers, and they can talk to them, they can interview them, and that person can make the decision with the potential investor, with the licensed professional, can make the decision of what's the best route for them. It's going to be different. Somebody that wants to come here and just buy something, they might just buy it in their own name. And, right now, currently, I think there's no estate taxes if you're on like estates of $12 million or less, I believe is correct. If you're an international investor, it's like $65,000.
Yeah.
So it's a huge difference, right? And $65,000 is a lot of money, let's be honest. But I mean, if you hold real estate, pretty much any piece of real estate for a few years in the United States, you're going to hit that $65,000. I mean, so that just takes it. It depends. Then, the CPA or attorney that you're working with there that we've kind of pointed you in your direction of, they can kind of help you and tell you, hey, you should have this entity. You should have this entity owned by a foreign trust. You should have this U.S. trust owned by shares of a foreign corporation. And it's going to be more expensive for these CPAs, let's say, than, Lance and you and I, we'd be getting for our CPA because of their knowledge that's very specific. But I talked to some attorneys that work with foreign investors, and they handle a lot of smaller tasks that you and I, Lance, would never pay an attorney $375 an hour to do, whether it's drive by a property or whether it's meet with an agent, because and that's I think how a more sophisticated, wealthy investor, the ones I speak to, they don't know an area when they're going into it. They're aware that they're going to have to invest money to make sure they don't get themselves into any trouble, and that they've done their due diligence, which is very important. And I think the other thing too is that they're relying on other professionals to vet other professionals. Like, for instance, my favorite is getting referrals, right? So if I'm going into a new market, I'm going to find a broker, I'm going to find referrals for property management, ask them for lenders. You really utilize the people that you trust there to find referrals for other people. And that's kind of the same thing, I think, with a lot of international investors that come that have means, right? And they want to invest in understanding, and then having this professional here in this country, CPA or attorney, speak to or work with someone in their home country to make sure that they don't have any issues where they live and in the US here. So, and then kind of walks them through the whole process. So I kind of give like an overview of pointing them in the right direction and then getting them prepped so they can invest here in the US.
Yeah, no, I think it makes a lot of sense. And that's a good pipeline, because of course, those are the problems that have to be overcome in order for them to even be interested in maybe when you have an opportunity, right? So sort of priming that pump and being part of that, but to add the value of, education and referrals and references. And I think that's just it too, is it's like for investors realizing that, always a couple of these themes that always come up, right? Is that at the end of the day, these are relationships, right? And so you need to build relationships with people. And for investors, I always encourage them to say, like, hey, when you reach out to an investment sponsor, whether they have a deal or they don't, and those sorts of things, that there's more that they can offer oftentimes. And of course, people are onto this now with the all these podcasts that exist, like yours and like mine, obviously. And, but a lot of syndicators and fund managers have realized that that's a really powerful way to build a network, right, of prospective investors, is you educate them first. And so, for those who don't, because there's still a lot of guys out there who aren't really taking advantage of that, and they're wondering why, they're having a harder time building their investor base and more efficiently capitalizing their deals. So I think for investors, really take people up on that. And that's why I like your angle. It's like, hey, there's people in foreign countries that want access to U.S. real estate, but all the barriers that exist to make that happen and to get connected with the people that can help them do it is a huge, huge value that you bring to those individuals. So I guess kind of moving off that, So for you, like you said, you've got these certain areas that you're looking at, but when you wake up in the morning, what's your box? Like what are the ideal sort of, what are you looking for? What are you hoping you can find? Because it's hard. You're going to have to touch a lot of things and look at a lot of things before you find something that works. So what are you hunting for?
So I guess on a daily, what I do is I work a lot with investor relations for us. And so it's in the morning, a couple hours I'm working on speaking to investors, speaking to new investors, speaking to potential investors, speaking to current investors. And then throughout the day, it's really with the different strategic partners, we work with different deals that we have going on. So if I'm handling, let's say, leading property asset management, I'm talking to the property management company on that. I might have my weekly call on that day. We're going to have a group call with our general partners on specific assets. And that starts off, when you're buying an asset, we usually start it off weekly as a GP call, then it'll go every other week, and then it'll go monthly. Maybe after 7 or 8 months, that'll go to a monthly then kind of call. So it just depends on where we are in the life cycle of different deals. Mm-hmm. Obviously, once a deal gets a little bit more, I think with real estate, the longer you own real estate, especially with what we're doing with multifamily, the less risky it is. So in the beginning, you really don't know what you get. You have an idea of what's going on, but until it's like 6 months is in, the property hasn't been, like I call it, initially stabilized, right? You haven't changed over all your vendors yet. Sometimes it might take you 90 days to figure out who exactly is in the apartment, depending on the grade of class of property that you're buying, right? That person could have moved out and it's their cousin living there for the last 2 years. It's been on the rent roll. So all these things that we were going through during the life cycle of the project. And really focusing on finding deals that pencil so we can put our capital work and then also our investors' money. Because we usually will invest, like our last deal, it was probably 25% of the raise was done by general partners, our own capital put into it. So it's that's something that I don't know most other groups do. I know that some groups do, and I know that some of them just do it for the pre-closing money, then pull their money back out. But with us, we put a sizable of money into the deals that we're working on.
Yeah, and I think that's having a sizable co-investment like 25%. Certainly would make one feel more comfortable knowing that the GPs have that kind of skin in the game, right? And I think it's one of the things that not to pass judgment on it, but I mean, skin in the game is a real thing. There's a reason why it's oftentimes sort of most investors, that's the best question they got in their arsenal, right? Is to ask that question. And I know I always encourage every operator or sponsor that I talk to, like, find a way, one way or another, to come up with 10%, right? Like it just make a habit of it at minimum, because just having that out there, it takes it off the table. But you see people that attempt to go and do deals where, like you said, they're going to have their pursuit cost in, and they come out at closing, or I would say it's not that it's bad. It's just that it's not great optics, right? And there's all these things that that exists. That, putting yourself in the shoes of the limited partners, right? I mean, they have no voting control. They have no say. They don't. Once they put the money in, they're really, it's not a great spot to be in. And so everything that an operator or a sponsor can do to alleviate those concerns, that's where my passion lies, right? Like, let's take it all off the table, right? Like, you don't want them going to bed at night, because the problem is, even when the deal's performing, oftentimes I hear from investors, they're saying, well, yeah, I'm getting my distributions like clockwork, but I'm a nervous wreck because I'm just terrified that it's a Ponzi scheme. How could it be going so well? And then when it's not going so well, then they're all upset because it's not going well. And I think that those are things that, that you can take off the table is providing more assurances. And it'll get more people to participate, obviously, when they can feel better about that everything's above board, because those are because it's hard to tell. Let's be honest. Like there always has been, and even more so now, that, it's a good thing. It's a good thing now that the ownership of a lot of these, especially multifamily is a good example, but even commercial real estate in general is just more and more over time is going to be owned or syndicated. So the ownership's going to be, much more diverse across a lot of people. And in many cases, those that are passive, whereas it's always been happening. Obviously, they've been syndicating capital for years. It's not a new concept per se, but that's good. That means that people can, without having to be operators themselves, invest in these things. But it also means that there's a bunch of people running around that you don't necessarily, it just, there's room for fraud and bad things can happen. So, let alone just whether or not someone can execute. To your point, as your dad taught you, right? It's just sort of stick to the areas where the good neighborhoods and the better properties. And because some of those, the properties that are, D, C minus sort of things or bad neighborhoods, like those are tough. Like, it's not, like I said, not to say that if you can't turn them around, but it's a lot more, it's a heavier lift. And one could argue, of course, the risk, the reward isn't sort of meet the risk that you're taking. So I mean, for you guys, I mean, as you're looking at deals with your partners, I mean, what's your process? Whether or not it sounds to me like oftentimes you might have someone else who sort of dug up a deal and then they're asking you if you want to participate. I mean, whether it's your deal or there's someone else's deal, I mean, I'm trying to get at, like, what's your criteria? Like what's your philosophy? What are the first things that you go to, like, to kind of sanity check something?
Yeah, that's a really good question. So normally with our strategic partners, we have 3 that we work with and they focus on different areas. So I want to see one of our strategic partners with someone with boots on the ground, like within an hour and a half, 2 hours of the property, right? Because I know that they're gonna be there twice a month when we start, at least maybe once a week when we start, and they're gonna be there once a month once we keep on going, right? And I know a lot of groups that check 4 times a year or something like this, and that's not usually how we work. I want to be there more often than that. But when a deal gets sent over to us, what we'll do is I review it. My first thing when I review deals, and I wouldn't say per se I'm an underwriter, but I can tear apart the T12, right, that they send over. And I'm really looking to reduce rents and kind of see how everything goes once we start reducing rents. Without even looking, I might pull up like apartments.com, something else really quick, and kind of see what's for rent. I might even pull up Craigslist and see apartments that are for rent, all different sources, because you have a lot of apartments.com that might be the same as that's on Zillow and everything else. And they tell you apartments here at 123 Main Street range from $900 to $1,400. Well, I can look in the pictures and see what the interiors look like, but I have no idea what the interior of the unit that they're talking about in this underwriting is. So kind of figuring out what we have there. Like, so with a unit mix, if we have 2 2s or 2 1s, what are they renting for a block or 2 away? And what condition are they in? Are they in like 1980s condition? Are they just been updated and it's like nice laminate countertops and black appliances? Or is it like granite and stainless steel? And get an idea of what the property looks like and the amenities. And then you're kind of figuring out where the rent, because I think that people get aggressive with the rent increases. Yep. And obviously, yes, in value add, I mean, you're going to need to have that 20% rent increase over the lifetime of that project to hit your targets. But I also like to see what other efficiencies we're working into the project. It's like that old adage where you're selling your house through a realtor and you're selling it for $500,000, and you go to the realtor and go, if this doesn't sell for $500,000, what else do you have up your sleeve to get me $500,000 of property? So like sell it without lowering the price. And the same thing is when I talk to, because I passively invest too. If I talk to someone, what is your other goal? How are you going to be able to get this return up, right? Increase the NOI without just raising rents. Anybody can raise rents, right? And I had an attorney like 2 decades ago was telling me, you can't just raise rents, right? It has to be an agreement between this. And it's a whole thing. I think people nonchalantly throw around raising rents or jacking rents up really is what happens in a lot of these hot markets, Phoenix, Tampa, where people are investing and where we have properties. Mm-hmm. And, they don't think about kind of what else can be done, like searching out. I'd rather see a lot of management inefficiencies than I'd like to see undervalued or underpriced apartments. So we were looking at one that was 300 units, should have 6 people working there, only had 2 people on site. So you could see that why they had 70% occupied, 70% occupancy. So right off the bat, we go through COVID 2.0, 3.0, 4.0. You can rent those apartments out with just some paint and some cleaning, and they can be rented as 1980s units and look nice, and they'll rent in that neighborhood without a problem. And then once everything stabilizes, we can start going through and renovating the interior of the unit. So you can start increasing that NOI right off the bat because of the mismanagement that was there prior. And that's the deals I feel the most comfortable with, especially where we are in this portion of the market cycle, because anybody can make money in 2010, 2011, 2012. I mean, it's where we are now. It's where you really have to be careful about the deals that you're entering into, because a lot of these gains, everybody says, well, if you look at any kind of, you talk to any operator out there and they'll tell you all this money they made on previous deals and everything. Well, half of that is really from cap rate compression, not from them fixing or upgrading the property, right? Increasing the NOI. It's really just been because more people are buying multifamily 2021 than they were in 2016, right? And there's more buzz around it now than there ever was. And so there's more syndicators, there's more nationwide syndicators. So people from California buying stuff in Orlando and vice versa. So it's something that I think you have to look into, and you got to really drill down into it, because as they say in every disclaimer, past performance is not, a future performance, right? And that's really important, that just because some deal they had fantastic years back, because there's deals I did in 2009 that I still own today that were fantastic, grand slams, right? But I can't say those numbers for something I'm buying today. I mean, it might be, we're shooting for a solid double, and a triple. And who knows, maybe we find something down the road. Maybe something happens a year now and it becomes a home run, but not something foreseeable. So,
yeah. So what other trends do you sort of see then? I mean, have you ever looked at other property types, or, I mean, are you just like super bullish on multifamily, or are there other things that, what in your crystal ball, I mean, what are you looking toward? I mean, are you sort of like, hey, let's stick with multifamily, it'll be harder to find a deal, just be really disciplined? Or, just curious as to like how you approach that. I mean, clearly it's easier for a passive investor to get, just like you said, I mean, a lot of it's common sense. I mean, once you realize that you just need to apply your own common sense to how you look at a deal, right? Of like, pullupapartment.com, would I pay $200 more just to raise the rents with no other accretive benefit to me? Like, no, I wouldn't. I'd go across the street. Yeah. Well, that's a problem. That would explain why it's, they got 70% occupancy. But just curious as to what, you looking forward, you kind of eat, breathe, and sleep this. I mean, this is what you do. So I'm curious, like, where are we headed? What, with that said, are you looking to other areas or mobile home parks or anything else outside of multifamily as a way to generate, above average risk adjusted returns, I guess is the way I put it.
Yeah. I mean, multifamily right now is super hot, right? And it's been just getting hotter and hotter over the last several years. And there's still deals out there. You can still find deals. I think that over the next 12 to 24 months, we're going to see even more of a compression in cap rates. I don't know how much though, so I think the values on properties are going to go higher. I think that people, especially after 2020, all the spending we did during that, printing in the US, I think that people are looking for a safe harbor so they can get some sort of high single digit cash on cash return while having their money hedge against inflation. I mean, I know I am. So it's something that when I put money into real estate, I know it's safer, especially if it's something that's cash flowing where I'm going to get a distribution every quarter. The other thing too is for other asset classes, we've been speaking to other operators that we've liked possibly partnering on for mobile home parks or self-storage. And these are other asset classes that are just getting hotter and hotter now. I think one that's coming up that hasn't been as popular mainstream is industrial. And I think different portions of industrial. So I guess you can consider for some part of it, self-storage to be part of an industrial. I mean, you're using warehouses in some specs. Sometimes it's also repurposing retail centers into self-storage. That type of stuff I'm very bullish on. I'm very interested in learning more about. But I also like the different parts of industrial as well outside of self-storage, such as cold storage and other things like this that are growing now with what we have going on with the whole everything going online, right? The whole Amazon effect. Yeah. And people are now, I think, I don't know if people are having as much food delivered now, like the regular groceries, as they had last year, but I feel that is going to be the trend, right? And that's going to be that that's where this cold storage comes in, right? Where not everybody might be going out to your supermarket and pick up stuff, right? They might have some of it be delivered. And that's where that comes in. And in a lot of parts of the country, that's in short demand. I mean, I know in Florida here, it's amazing that I was reading some articles about it and how industrial is an asset class that they just don't have enough of. And it's not something normally that people want to build. I wouldn't say it's as disliked in neighborhoods as mobile home parks, but it's something that is, self-storage. No one wants a self-storage unit in their backyard, right? They want to be able to drive to it on the way to work, but do they want to have it, in their backyard, or do they want to have it a 15-minute drive? So I think that's, they want to have, this is all different things that we're looking at, but I feel industrial is something that's it's coming up. And I mean, it's hot now. And I have an attorney that I work with in Texas, and that's all he's investing into, just industrial. And it's very interesting because it's a very growing asset. So I see that class going, really taking off more in the next several years.
Yeah. So when you talk about, that for you guys, maybe looking at some of those others and getting more involved in them, that would mean obviously sort of vetting additional sponsor partners. So maybe give us a little insight into what your process is for vetting a new sponsor, partner that you might want to do business with. I mean, what you obviously okay, you're a multifamily guy, you're in the areas that, you're doing business, like you said, in those areas, but what else are you doing to ensure that, hey, these guys are a good fit and someone that I want to be doing business with?
I would probably invest passively with them and see how my communication goes and see how everything goes, and they'll know upfront. Obviously, we've been talking as a possible general partner kind of arrangement relationship. But if you come in as a limited partner, I'd like to see how reporting is. I'd like to see the communication. My first passive investment was very good. I had great communication with it. The second one wasn't as great. The property is doing well. It's just everybody has their own management styles. And I was at a conference a year and a half ago, and somebody was got on stage and goes, who gets emails from syndicators to invest in their deal? And everybody raised their hands. And who's invested into a syndication that wants to hear better communication, right, from their sponsors, right, from the operators? And almost everybody kept their hands up. And it's very interesting because I do when I'm working with investors, that's something that I always do. If I get information on one of our calls, whether it's weekly or biweekly or monthly call, and before we have our formal monthly report that goes out to them, I regularly send out emails that are just like a few bullet points. You know what I mean? And it's like, hey, we had, on this property, we had 9 evictions. We got possession of 4 of them back. And, some in 2 more bullet points of something, and formal report will probably be out, we'll be at the end of the month. And that's the kind of stuff I like to see, because if I'm working, I want to get that email and that goes, fantastic, that's going well, right? And you avoid a lot of, I don't get really phone calls from current investors, because if I'm taking notes when I'm on the call with the GP and it's something that I'm talking to them about and go, hey, this is what we got. And I can then just transfer those notes into an email, and very straightforward. You just send it to them. So it's really kind of figuring out exactly what you find and making sure that would you be happy to be an investor in that. I also want to look at the experience of the management team. And I really want to see people that have been in real estate pre-2008. Because let's be honest, like we were talking earlier, last 10 years, anybody can make money in real estate, right? In multifamily. If you imagine buying something with 10-year debt in 2011, right, and selling it this year, you would be giving a crazy return to your investors, even if you refinanced it twice through. So it's something that, I want to see what happened. What'd you guys do when you went through 06, 07? And I was self-managing properties for 06 to 2012. And, that's the thing about the value add. And the value add is what a lot of these newer syndicators, that's the only tool they have in their toolbox. And my thing is looking for the mismanagement is one thing that I'm searching for. But what they have is the value add. But the value add doesn't work in every portion of the market cycle. How many operators, honestly, who knows what they said on a podcast, were honestly raising rents mid-2020, right? They would have been crazy too. You're going to take someone out that's paying rent, and that they've been paying rent, so their credit's higher than any new tenants coming in, right? I mean, if I'm getting $1,000 a month and they're, hey, we get 1075 for it. No one's leaving, right? If they're paying rent, they're staying. I don't care what they do, right? Unless they're, a nuisance or something else to other tenants. But if they're not a problem, they're not paying anymore. I mean, that's good management there. If you're going in there and you're like, oh, we're going to spend $5,000 to try to raise rents, $150 a month. Well, that's really risky at that point, because who knows on this new tenant that comes in that you can't vet them. They could be a first time renter, right? Yeah. That's why they're not in the eviction book. All this type of stuff. You can minimize risk, but you can't alleviate it. I mean, so the thing is that 2020, I mean, we started raising rents again in like December of 2020, just to keep up with the market in different places we are investing in. But let's honestly, no one was fulfilling their value add process. Maybe if they had an A-class unit, they might. But for the normal workforce housing that most people are investing into, I don't think you're raising rents during that, or you shouldn't. That's bad management. So I think that speaking to them and seeing what other, what happens, how do we manage this property better? And I think spending more time on the asset management and making sure that, I also, as a passive investor, like researching the property management company. And I know that I hear from different gurus out there, make sure that your property manager doesn't have property in the neighborhood or doesn't own anything. I'm complete opposite. I want to be there with the property manager in the front yard and have them tell me that we manage that, we manage this, we manage that over there. They know that area better than I'll ever know it. They know the demographics of the renter, which is most important, right? They're going to put someone on the ground that understands the demographics, like what's important to that renter. Right? Because we're buying all these $10 million assets plus, and the person that's talking to your tenant makes $45,000. That's usually how it is. Yep. And the guy coming there to fix the clog in their AC line, drain line, is getting $45,000. Right? So it's something where you have to make sure that the people hiring that, which is usually your third party management company, that they have good people they're putting in there and they're not changing the people every afternoon. Right? You're going to have someone in there, and I don't want to hear, well, why did we get rid of John and Susan from the front office? What's going on there? They were there for 18 months and all this kind of stuff. It's just something that you want to make sure that they're building that, because the turnover is the most expensive, right? And it's the most important factor that you can really minimize if it's managed correctly. And I'm not saying somebody has to stay there 10 years. I have a tenant that's actually stayed in one of my properties for 10 years, which is kind of crazy. But if you can just take them from 18 or 24 months or 12 months and just bring them to 24 months or to 36 months. On your bottom line, without raising a 10 cents, right, of rent, you have added to the bottom line. Or even taking that, hey, it used to take us four weeks to clean up this unit. Now it's taking us 10 days, right? And we have really good traffic that comes to the property. So we don't even have to pay to market it. And we can have someone in there within 3 weeks. Like, that's good management, right? Just taking away a week. And you might say, oh, that's nothing. Well, it is when you have 100 units and you have 5% of those always turning. Yep. So these are things that I think people don't look at. And it's very important that they should be looking at when talking or figuring out where to invest with sponsors. Yeah,
that's great stuff. Great insight. Cool, man. Well, why don't you tell us where people can find you? Maybe your, the podcast and your website and all that good stuff.
Yeah. So my company's Harborside Partners. If you're interested in investing passively or actively in real estate, I do a free 30-minute call with anybody. You just go to schedulecharles.com, and that goes to my personal website, a page there you can set up, but you'll see all my other information there for our company, for podcasts, for anything else. So reach out, set up a call, and we can kind of see where you are and where you want to go with your investing career, and look forward to talking to you.
Yeah, cool. All right, Charles, I appreciate it. It's a good time. Take care.
Thanks, Lance. Thanks. Have a great rest of your week.